For joining us on India Business Hour, I'm Shireen Bhan. Let's first take a look at the action on Dalal Street. After yesterday's monster rally, the bulls took a breather and profit-taking saw the Nifty and the Sensex close 0.5% lower. However, the Nifty holding on to the 12,000 mark while the Sensex stayed above 40,000. The broader markets faring slightly better than the benchmarks. Mid-caps ended flat while the Nifty Bank ended mildly lower. Well, that was the equity market action. In the money markets, the rupee rose against the US dollar, hitting a near 2-month high. This is in line with other Asian currencies. And remember, the dollar has been under pressure after a major fall in US Treasury yields over the last few weeks. In the bond market, the 10-year were largely stable today after hitting the lowest level in 18 months. That was the bond action for you. But the 3-day meeting of the Monetary Policy Committee has started. The decision on policy rates will be announced on Thursday. After 2 successive rate cuts in February and April, what can we expect this time? With growth hitting its lowest level in 5 years, the chorus for a rate cut is getting louder. Majority of the market participants polled by CNBC-TV18 expect a rate cut. Ritu joins us now with the highlights of the key findings. So, Ritu, 25 basis point cut is what the street is expecting.
The Monetary Policy Committee of the RBI is expected to cut repo rates for the third time in a row, bringing it to 5.75% according to our poll. Now, while on one hand, low growth and soft inflation will build the case for a rate cut, uncertainty about oil prices, weak El Nino conditions, slow transmission of rate cuts by banks could hold the RBI's hand. But of course, the majority seems to think that the case for a rate cut is stronger. Therefore, 70% of the respondents to our poll expect the repo rate to be cut by 0.25% in this policy. 10% are even expecting a 35 basis point rate cut from the governor. For the full financial year FY20, majority of the respondents expect a 50 basis point cut. Some even expect up to 100 basis points cut. Now, on the macro picture, 70% of our respondents again expect RBI to lower the GDP growth forecast for FY20, and accordingly 70% of our respondents also expect the GDP growth forecast for the first half of FY20 to be lowered in tandem. However, for the second half of this year, GDP forecast of 7.3 to 7.4% growth may be left unchanged. Do remember, the growth had slowed down to 5-year low in the Jan-March quarter of 2019, and that may well be one of the factors that pushed the MPC to go for a rate cut. The other big factor, of course, will be inflation, and the majority of our respondents expect the CPI forecast for the first half of FY20 to be left unchanged. As for the second half of FY20, half of the respondents expect that 3.5 to 3.8% CPI projection to also be left unchanged. Do remember, CPI edged up in April to 2.92%, but it continues to remain well below RBI's comfort zone of 4%. Another factor that could again support a rate cut by the MPC. However, the economists polled by CNBC-TV18 do not expect RBI to change its stance from neutral to accommodative just yet. And lastly, the statement of the policy itself, that is expected to be far more dovish compared to the previous policy.
Ritu Singh, thanks very much. That's the expectation that the market has from the MPC. Now, here's an interesting story. The year-long grouse of NBFCs, mutual funds and India Inc. is that liquidity has been too tight. No longer holds true, perhaps. RBI data indicates that banks have actually lent over 86,000 crore rupees to the central bank through reverse repo yesterday. Now, if you compare this to the month of May, when banks actually borrowed up to 1 lakh crore rupees from the RBI. Now, this is largely because the government has begun spending money lying idle in its account throughout May. Lata joins us now to explain this to us. So, Lata, liquidity crunch or no liquidity crunch?
Well, we know that we have been speaking about this tight liquidity. I mean, it's almost a cliched usage now, and it has been that way ever since IL&FS. But now several positive factors are aligning to make liquidity, I think, comfortable, not just yesterday and today, for which we have data, but probably for the next 3 months at least. It's only in September, October festival season that people start withdrawing cash. Now, what are the reasons? One, you can clearly see in RBI data amount of government balances that used to be 70,000 crore, 69,000, around that figure for a better part of April and May. And today that number reads 0. So government has started spending the money which was just stuck up there. That's coming back into the banking system. And then just to the number, banks used to go and borrow from the Reserve Bank all through the last many months, and even in May, anything between 50,000 and 1 lakh crore rupees. But yesterday, And day before, we have seen banks actually, giving away money to the Reserve Bank, which they have excess. RBI does a lot of repos and reverse repos. Repos are for 1 day, 2 day, 3 day, and likewise reverse repo for several days. Reverse repo is where they absorb money. If you did the total math, then yesterday the Reserve Bank absorbed 86,600 crores from the banking system. Up until May, they were actually lending to the bank. So that's clear proof that liquidity has returned. Now, one other big reason why this has happened is that, RBI has been doing OMOs for many months now. And in March, they mixed it with FX swaps as well. All that is also beginning to work. But a more important reason is that in the past several months, we also saw a lot of cash withdrawal. During harvest months, there's cash withdrawal, festive months, election time. But June, July, August is usually the time when cash returns to the banking system. Not much withdrawal is done. So anyway, we were in for a liquidity surplus time. This is only going to get better. Of course, you will see a little bit of liquidity tightness when companies pay advance taxes in mid-June. But that will be a temporary problem. And RBI has already announced that it will do OMOs of 15,000 crores around mid-June. So even that will be met. And left to itself, the banking system will also see an inflow of cash because about 53,000 crore of old bonds get redeemed in June, and another 43,000 crore get redeemed in July. So be prepared for a situation where you are going to see surplus in the banking system, and that usually will mean that banks, instead of giving it to RBI at all of 5.9 or 5.95%, will rather buy bonds. Either government bonds or corporate bonds or commercial paper. And already we have seen yields on corporate bonds falling by about 40-50 basis points just in the last couple of weeks. So the liquidity rant is over.
In addition to the redemption, of course, there has been month-end spending by the government also, as the government pays out salaries and other payments which are due. That apart, seasonally we are entering a period where the currency in circulation actually comes back into the system. Whereas usually April and May is when the currency kind of drains out of the system, and June, July is when we see it coming back into the system. So that should also be favorable for liquidity. On top of that, of course, what RBI can do both in terms of FX operations and, like you mentioned, open market operations. So they've already announced one OMO for the month of June for 15,000 crore. So even as we are entering into a seasonally good period for liquidity, RBI is also trying to do its bit by infusing more liquidity. So our sense is that through June, at least in the first half of June, the surplus situation will continue. Of course, subsequent to that, there are tax payments due to the government, both in terms of advance tax and GST. So that time, again, the government surplus will start building. And then again, in the month end, again, they will start spending. So by and large, if you take on an average over June and July, we do think the system should remain in surplus on most days.
All right, so could the liquidity constraints that we've gotten so used to talking about be a thing of the past? Data from the Reserve Bank certainly seems to suggest so. Thanks, Lata, for joining us with that. Speaking of liquidity, the housing finance sector's liquidity crisis does not seem to be letting up. For now, CNBC-TV18 learns that the housing finance company DHFL is likely to have missed the deadline to pay NCD holders 1,150 crore rupees. However, sources have clarified that this miss does not constitute a default by the company. It is a delay. CNBC-TV18 Sumaira Abidi joins us now with more details. Sumaira, where does this leave the company and what does it have to do in order for this not to be termed a default?
Shireen, thanks very much for that. So through the day today, actually, there have been feelers saying that there was a possibility this payment would not be made on the NCDs. What happens now is that according to their terms and conditions, they have 7 days grace period to make good this payment. Should they pay within that, it would pass off as a delay, like you said, and not a default. What we do understand is that there is some sort of a securitization deal which is likely to have gone through, for which they will receive payment on Thursday or Friday and would use that amount to make the payment. Should that happen, all would be well till the next time. Now, crucial in this is how the rating agencies would see this. What I understand is that the rating agencies have already factored in today's delay into the valuation as of now. So as things stand, the ratings exist at BBB, which is just one step short of junk. But let's see if the interest payment comes through later in the week or within that 7-day grace period? Back to you.
All right, Sumara, appreciate you joining us with those details. So a delay, not a default just yet. That's the DHFL cash flow problem. Well, we've got lots more coming up. Here is a CNBC-TV18 exclusive on a story that we broke this morning. India's electric vehicle mission drive could move into the fast lane. In a bid to tackle air pollution, the Road Ministry is set to propose allowing the sale of only electric three-wheelers and in 4 years, phasing out all the petrol, diesel and CNG variants. So April 2023 onwards, only electric three-wheelers will be sold. This is, remember, a draft notification that's been put out by the Road Transport Ministry. It will be put out by the Road Transport Ministry. This is source-based information. April 2025 onwards, only electric two-wheelers under 150cc will be allowed to ply. Now, all of this is expected to happen between 3 to 6 years. The auto industry is divided on the proposal. Bajaj Auto has called the proposed move impractical and insensitive and cite the electric vehicles currently demand less than 1% of the market share. So is this plan within the timelines possible, feasible, practical? Anu Sharma joins us with more details on this proposal. Anu, over to you.
So in an attempt to curb pollution and fast-track the adoption of electric vehicles, we've learned from sources that the Ministry of Road Transport and Highways has started working on a draft notification which will propose sale of only electric three-wheelers from April 2023 and sale of only electric two-wheelers under 150cc category from 1st of April 2025. Now, if we look at the numbers, as of now, 80% of the domestic two-wheelers sales are from the under 150cc category and less than 1% of the total domestic two-wheeler sales are from the electric vehicle portfolio. So this means that it is likely to lead to serious overhaul of the production and sales network and strategies for the two-wheeler and three-wheeler manufacturers. That is what the industry experts had to say on this. Also, if you look at the three-wheelers, there are issues regarding range anxiety, regarding cost structure, and because these vehicles are largely used for commercial purposes. So these are the main concerns regarding the two categories of vehicles, and as of now, the government is expecting that they will be able to seek the necessary approvals and formalities will be completed very soon. And in the next 7 to 10 days, this draft notification will be floated for public consultation for stakeholder comments.
Our view is that we should, BS6 is coming in now, and we should give ample time for this transition for BS6. Our view is that for three-wheelers by 23 end, you should have India going fully electric. And our view is that by 2025 on two-wheelers, we should, when you look at this and you converge this with the FAME, the government is supporting electrification. The government is providing support. And our view is that the future is electric. The future is sharing, and we should be able to clean up our cities. We have some of the most polluted cities. We should clean up, and this would require.
We can understand the government's priority as the bulk of the automobiles on the road are two-wheelers and three-wheelers, but the industry also feels that they're going through a disruption right now, and this will cause further chaos.
This would not cause further chaos because we are talking about 6 years hence, not now. But we need to lay down a clear roadmap for the future. And that is what we are laying down, so that everybody should prepare to clean up the cities of India and provide your life, and the quality of life of all of us is far more important.
I think if you look at three-wheelers, which we can talk about, I think it is a right step. Whether it happens in 2023 or 2025, it's not a matter. I think we have to have a vision of when we want to bring sustainable mobility in last mile. And that is the vision we launched with Trio. If you look at Trio as auto, the India's first lithium-ion auto, it focused on energy efficiency, it focused on customer. we focus on revenue of the driver as well. If you look at Trio as a driver, he will be able to earn 2,000 to 4,000 rupees a month with the current FAME scheme. A take home after paying an EMI on this. So the operating cost of the vehicle is very low. So when we say the three-wheeler can become electric, it's not just sustainable alone. It's an economic benefit to the driver. It's a benefit to the society. And as an industry, we'll have to get prepared for the government's vision.
All right, so some views there coming in on electric mobility. But let's do a quick fact check on automobile sales in India. Basically, a comparison between those running on fossil fuels and battery-powered vehicles. Now, sample this. The overwhelming majority of vehicles on Indian roads are two-wheelers, 79% two-wheelers. This is according to the Niti Aayog's report that made its pitch for total electrification. Now, 79% of the vehicles on the roads, as I pointed out, two-wheelers, then come three-wheelers. That's at about 4%. Buses and cars are actually just a fraction of automobiles sold in the country. That also begs the question on public transportation and the need for more efficient public transportation. Now, two-wheeler sales, let's take a look at that. Over 2 crore two-wheelers are sold, which are powered by fossil fuels. An overwhelming majority of these, almost 80% I would imagine, are below the 150cc mark. Now, electric vehicles sold last year, look at this number, 1.2 lakh vehicles, which translates into 0.6% of total two-wheelers sold in India. The deadline to go electric, according to the Road Ministry's draft notification, 6 years. Now, among three-wheelers, electric vehicles do fare much better in comparison to two-wheelers. So if you take a look at the fossil fuel, over 7 lakh three-wheelers were sold. And if you take a look at the electric three-wheelers, over 6 lakh. So the difference, the divergence isn't as stark and significant. EVs account for about 47% of sales. Deadline to go all electric, 4 years as far as three-wheelers are concerned. Now, finally, let's take a look at how India has set its electrification target compared to the world. We want three-wheelers to go all electric by 2023. Two-wheelers under 150cc to go electric by 2025. Cars, there's been a lot of back and forth. This is actually not the deadline that's been set in stone, but broadly 2030. Look at Scotland, 2032 for all electric. France, 2040. Britain, 2040. That's where the world is headed, and India is trying to leapfrog, saying, why do we need to pay follower? Is that good enough? Joining us now to take this discussion forward, Puneet Goyal, co-founder of Blue Smart Mobility, and Manu Sharma, Director Corporate Affairs of the Society at Manufacturers of Electric Vehicles. Thanks very much, gentlemen, for joining us. Manu, let me start by asking you, we just laid out where reality currently lies when it comes to electric mobility in the country. There's CapEx requirements on the part of the OEMs. There's CapEx requirements on the part of the supplier ecosystem. Then we don't even know in terms of technology, whether OEMs currently have the technology that's been proven, tested on Indian roads. Is this timeline for complete three-wheeler electrification virtually in 4 years and complete two-wheeler under 150cc electrification by 2025 doable?
Yeah, hi Shireen. Thank you for the question. And basically, one of the major success story that we keep reading, which is the e-rickshaw story of India, which is actually unofficially came to India and has given a last mile, connectivity solution to all the metro people who are actually living in cities, and that has given. Itself it's a great story. And secondly, the two-wheelers are already in the race. There has been certain, I would say, delay in a long-term plan, laid out plan for electric mobility, which was needed. And I consider this as a very brave move very bold move by the government, and this should yield very positive results, considering the world's 13 most polluted cities are in India right now. And and as far as infrastructure is concerned, as far as the industry readiness is concerned, so
go ahead.
Yeah, so as far as the industry readiness is concerned, the industry is there I mean, there are companies who've been into electric mobility for the past 10 years or so, and they continue to strive further with all the roadblocks. And as far as
no, but Manu, let me stop you there. Let me stop. Okay, let me stop you there, and let me put that question to Puneet. And Puneet, I'll come to e-rickshaws in just a second, but let's pick up on the last point that Manu mentioned, that there are companies that have been trying to go electric in India for over a decade now, and we know what the statistics look like at this point in time. Okay, we've got a FAME policy which has allocated 10,000 crores. It's doubled it over FAME 1 for the next 5 years. But, you know, do you feel confident of being able to go all electric in the next 5 years?
Sure. I think the right time for us to go all electric will be 2047. I think we got independence in 1947. It will be 100th year of our independence when we can say we are all electric. I think the automobile companies have made thousands of crores of investments. It won't be very easy for them to go all electric now. Second point is that the cost of battery is very high right now, and the battery costs are going to go down over the next 10 years' time. And I think 2047 should be the right time when India can say, yeah, we are all electric now. And that's a very, very good time for us to reach that.
And I'm glad that you brought up the cost issue as well as the battery issue, because nobody is manufacturing batteries in India today.
We're importing cobalt, we're importing lithium ion. We don't have the reserves in India.
Exactly.
And also we don't have the technology to manufacture electric cars. Currently we only have Mahindra and Tata manufacturing electric cars. And the global giants like Hyundai, Nissan, Renault. So 2019 globally is a tipping point for electric mobility, and these countries also have targets, but I think they themselves will, I think exceed another 5 years, supershoot by another 5 years. So UK, when they say that, I was in UK a month back, and they say 2030, but 2035 is. I think
what they're realistically working with.
And India, because we are a huge country, I think 25 times their size, I think we will take a longer period for us to go all electric. And we have different, subsets.
You're right about that. And Manu, let me come to you now, and let's talk about costs. Let's take a two-wheeler, for example. Today, a below 150cc, 100cc motorcycle, which is 80% of the market, is available for 50,000 rupees, if not less, with discounts. Now, an electric two-wheeler, given the current costs as far as batteries, etc. are concerned, will be in excess of 1 lakh. Even with the FAME subsidies coming in, it's probably not going to be able to meet the difference. So how does this work? I mean, industry is going to have to put money in, create the demand as well. But how is this realistically going to work?
See, the sticker shock is something that we industry and the customer has been fighting, and the majority of the reason is there's a huge cost of battery. Now, as the other panelists have already said, that the battery is being imported right now, and there's nobody is manufacturing a battery in India. So, one of the major component of FAME 1 was to support the supply side for making batteries and other components in India. So somehow we didn't have that, did not trigger off as it should have. So as soon as the battery cost comes, in a long run, every electric vehicle actually is very cost effective, and the cost, in a simple term, that people actually
the running cost
of fuel also.
No, I understand the OPEX model, which is what. I understand the OPEX model, which is being pushed by companies saying that running costs will be much lower. My question, though, is that today you do not have anybody manufacturing batteries in India. Even if somebody were to start to manufacturing batteries in India, it will take the next 2 to 3 years for them to be able to get capacity up and running on the ground. Hence my question of going all electric, is that realistic and is it doable? But, Puneet, no one wants to perpetuate the thought and the argument that India should not aspire to go electric, or that we should live with polluted cities. I mean, we want to deal with pollution. The question is that, will this ensure that the electric mobility mission actually ends up failing.
I don't think it would fail.
Yeah, so my limited point is, should we go phase by phase? Should we look at, take 20 cities to start with? Should that be the first approach?
I think absolutely right approach. I think at Blue Smart, we're doing exactly the same. I think India has, India is full of different cities and every city has a different problem. If we take Delhi, Gurgaon is the world's most polluted city. So we started Blue Smart here, and the whole idea was to start our ride sharing and car sharing service. And once we expand, we get the traction, people start using electric cars. I think people to switch to electric will itself take about 5 to 7 years' time. There's not a lot of charging infra available. So, we need to have charging infrastructure also will play a very, very important part in people to switch, to completely switch to electric. So I think lithium-ion battery costs and also availability of charging infra. I think these both will solve a lot of problems. And going forward, I think Delhi NCR and Bombay will lead the way in terms of electric penetration.
We do want our cities to be cleaner. We do want to move towards cleaner technology. The question is, what should be the regulatory architecture that will spur that and not lead the movement and the mobility drive to fail at the very start? Puneet and Manu, thanks very much for joining us here on CNBC-TV18. But state-run fuel retailers Indian Oil Corporation and Hindustan Petroleum have come under the tax scanner. Shares of both companies tumbling in trade after the Director General of GST Intelligence booked cases against them for evasion of excise duty. Both HPCL and IOC contest the claims. Timsy Jaipuria broke the story. Joins us now with more details. Timsy, what is the basis for this claim that the GST Intelligence is making, and what is the response from the companies?
Well, that's right. What we pick up from sources is the fact that DG GST Intelligence Pune Zone has booked a case against IOC where they allege IOC of evasion of approximately 4,000 crore of central excise duties. The case involves non-payment of duty on sales of ethanol blended motor spirit. Meanwhile, CNBC-TV18 sent a query to IOC where the spokesperson said that they are contesting the claim with the tax authorities. On the other hand, DG GST Intelligence Visakhapatnam Zonal Office has booked a case against HPCL. Again, the case is alleging evasion of about 346 crores in central excise duties of evasion. However, the case involves transfer of petrol, diesel and kerosene by HPCL via their Visakhapatnam, Vijayawada, Secunderabad pipeline. Government's view is that the HPCL did not pay at the higher rates as it was required to when the products were being carried intermixed. Sources said that HPCL has voluntarily paid about 5 crore towards their liability so far. But when we spoke to the CMD of the company, MK Surana, he said, and I quote, "We do not agree with the contentions in the show cause notice. We are replying to the same." So all in, let's see whether it's an anomaly in the law which government needs to now address, or it is a case of the tax authorities where they are alleging tax evasion and they would want companies to come and pay up. Let's see what happens finally. We'll keep you posted on it.